Okay, so let's talk about probability of profit. I'm going to go and call this POP for short. Basically, whenever we do a trade, we can do a calculation and figure out what exactly is the probability of profit of this trade. So this is very beneficial for your trading plan or for your any prospective trade that you're looking at. You can say, you know what, I'm going to put on trades that have a 60% probability of profit, and I'm looking for this much return, or a 70% probability of profit, or 20%, or 90%. And normally, if you buy a stock, you have a 50-50% chance of it going up and a 50-50 chance of it going down. Same thing with if you buy a call option or a put option, but in our particular trades, actually you can do the same thing if you just buy a call or buy a put. You can actually figure out what percentage or what likelihood that trade is going to make money. So that's what we're going to talk about in this video. And now each option trade, like I said before, has a probability of profit. And the probability of profit can actually help you determine if you want to make the trade or not. So if you are a very conservative option trader, option seller, and you only want to deal with trades that have a 90% probability of profit, then you can do so. If you're more aggressive and you like, say, butterflies, then you can choose a 40 or 50% probability of profit. It all depends on the strategy. It all depends on your particular risk tolerance. Now, the probability of profit should be part of your trading plan. So if you're doing a certain type of strategy, it should be part of your plan that I'm only going to do trades with an X probability of profit or higher. So an example of that would be, I'm only going to do credit spreads, and I'm only going to do them with 30 days to expiration or less, and I'm going to look for an 84% probability profit or more. So if they're 32 days out, no, I'm not going to do them. I'm going to wait 2 more days until it's 30-day expiration, and if it's giving me a 60% probability profit, I'm not going to take the trade, even if it's going to give me 90% return on my money. But I want it. I'm only going to do 84% or more. So I could do a 90% probability profit, but my minimum is 84% probability. That's one example of a trading plan that you could have set up. Now, the POP is going to help you determine if your trade is too risky as well. So if you're doing a credit spread, or if you're doing an iron condor, and you have a 20% probability of profit, then you're too close to the money. You're very close to the money, and you're probably going to lose on that trade. It can also help you determine if you've done the trading correctly. So if you're putting in a trade and you should be getting a 60, 70, 80% probability of profit, but it's telling you have a 40% probability of profit, then you probably did something wrong. So it's another check just to make sure that you're entering the trade correctly. And the big thing about probability of profit is that it's going to help you pick your strikes, especially in credit spreads. So a lot of times, you'll find a trade, you'll find a stock, say, okay, you know what, based on my technical analysis or based on anything else that you want to look at, this stock is trading in a range and it's not going to go below, for example, let's say 50. It's not going to go below 50, and I want to trade it this month or certain days left to expiration. What strike can I use? I would like to I would like to go and say, you know what, I want to find a strike as far below 50. I don't mean, though, I don't think it's going to go below 50. I want to find a strike that is as low as I can go below 50 and still get a decent premium. But, just in case the 50 is broken, the 50 trend line is broken. So you go and you can look at the option chain, and you can actually see, okay, fine, at 50, I'm getting, I have a 70% probability of profit. At 50, at 45, I'm getting a higher probability of profit, and then you look at that and compare the premium that you're getting and the reward, or the return that you're getting, in order to determine if you want to go at the 50 or the 45 or the 40 or the 35 or any other strike. Now, how is this determined? How is, POP determined? Well, actually, it's a very sophisticated mathematical calculation. We use statistics to determine what it is. And there are many different things that go into the formula. Volatility of the stock, days to expiration. These are just two of the items. Also, the type of option pricing model that you're using. There are different ways to value what an option is worth. Black-Scholes is one of the most popular ones. You know, if you use Black-Scholes, your pop will show up as 1%. If you use a different pricing model, it might vary depending on the prices of the options and whatnot. It is a very complicated formula, and something that we're actually not going to get into here. But you can look it up online and see what the formula is. I'll show you two ways that you can do it without the formula, because I don't use the formula. I never have, never need to. But the one thing I want you to remember is that pop it's a tool, but it's not guaranteed. You know, I mean, it's wonderful. It's great to say that, hey, you know, I'm doing trades with only 90% probability of profit. That means I'm going to win 90% of the time. I wish that were true. But it doesn't always work that way. Just because you have a very high probability profit, you can still lose money. There is still that 10% chance of you losing money, and if something is, you know, if the variables that you put into the calculation are garbage, then your result, your probability of profit that you came up with is going to be garbage. So if the volatility of a stock all of a sudden changes, then your pop is going to be wrong. So you have to remember that things need to stay constant while you're in the trade. If they're not constant, then your pop is going to change and the whole trade is going to be off. And most pop calculations are based on a 68% certainty. So if you know anything about statistics, you know that you know, if you go out one standard deviation, you have a 68%. You can speak with a 68% certainty. 2 standard deviations is, I believe, I don't remember, I think it's 92% certainty, and then 3 standard deviations is 98%, or they're different bases of certainty that you can say. So any pop, most of the calculations that people say that, you know, this trade is going to give you a 90% probability of profit. Well, yeah, it's a 90% probability of profit, but it's only a 68% chance of that profit potential coming through. So it's a good way, it's a good tool, but take it with a grain of salt. So now I said there is a way to calculate the pop mathematically. We're not going through that here because it's going to be too complicated, and plus I'm not that good at math. So I'm going to go over the 2 simple ways that work well enough. The first off is by using delta. Now delta is an option Greek, and we're going to cover that in 1 second. And then the second way is by using your broker software. Most of the brokers nowadays have very good, very technically advanced free software that you can use, and by using their charting system, you can pretty accurately tell what the pop of a trade is going to be. So we'll go over an example of that. Now, to use delta to find the pop. Now, here's an example of a credit spread. The delta of the short strike tells you the probability of that option expiring in the money. Again, the delta of the short strike, you don't need to look at in a credit spread, you don't need to look at the long strike. You need to just look at the short strike, the one that you're selling. Take a look at the delta of that option. And if you don't see the delta on your option chain, there will be a way that you can manipulate the screen so that it'll show you the delta. And the delta is going to be given to you in a decimal. So a .15, .20, .90. That is the delta of the trade. It could also be negative, so a negative .15 if you're working with other options. So look at the delta, and that delta will tell you the percentage chance of that stock or that option being in the money, expiring in the money. Now, we don't want in the money. We want out of the money, right? We want it to be expiring worthless. But if you have a call, and say it has a .15 delta, that means that that particular call has a 15% chance of expiring in the money. Now, if we're going to buy that call, that's, you know, it's not a good bet because you only have 15% chance of winning. But if you sell the call, you have an 85% chance of making money because you have an 85% chance of that particular call expiring worthless. So if we did a credit spread and the short call was a 0.15 delta, that means that our trade has an 85% chance of making money. That would be our pop for that particular trade. Now, again, with credit spreads, we are only concerned with the short option expiring worthless, because if the short option expires worthless, obviously the long option will expire worthless. So we're only looking for that particular delta when we try to figure out the pop. Okay. Now, let's go ahead and take a look at how you find the pop on using your broker software. And in this particular instance, I'm going to be using the Thinkorswim platform. Other brokers have their own different softwares. So here we are in the Thinkorswim trading platform, owned by TD Ameritrade. And any broker that you use will probably have something similar to this. You can ask them how to do this on your particular platform if it's much different from here, but I'm just going to go ahead and use this as an example to show you how to choose and how to determine probability of profit on credit spreads. Let's go ahead and do it by the delta way, and then we'll also do it by the chart way and compare the two. There should be a little bit of difference because the delta way that I showed you is it's a rough guesstimate, it's not exact, and then the chart way will be a more scientific number. It'll be a more exact number. So right now what we're looking at here is this is IBM, as you can see, IBM. And this is an option chain of IBM, and it uses the different months. There's December weekly, the December, which has 11 days to expiration, and then January, which has 46 days expiration. These are the calls on this side. These are the puts on this side. Here are the strikes going down. As you can see, the different columns, you have bid, ask, mark, and net change. What we really want is to look at the delta. So we'll have to change one of these columns here. Let's go ahead and change mark. Delta is probably in here. Yeah, there we go. There's the delta. You'll notice that puts have a negative delta and calls will have a positive delta. So let's go ahead and look at some calls. And right now, there's 46 days to expiration. IBM is trading at 190.84. Now, if we look at the 195. Look at the 195 strike call, which is about $4 away out of the money. This software is telling us that this call has a delta of 0.4. And in other words, that is telling us that this particular option has a 40% chance of expiring in the money. Conversely, it has a 60% chance of expiring out of the money. So the 200 has a 20% chance of expiring in the money. The 205 has a 17% chance of expiring in the money, and the 210 has a 9% chance expiring in the money. So if we had bought the 210, according to the math here, you have a 9% chance of it getting somewhere above 210. Doesn't mean you're going to make money because you still have to pay for the option, but you have a 9% chance of IBM getting to 210. So even if you're looking to buy a stock, if you're looking to buy a stock and you're looking, what is the chances of the stock moving up or chances going down? What are the market makers thinking? Well, then you can come here, look at the option chains, look at the deltas of the options, and you can figure out what the market is thinking in terms of if this stock is going up or down. So, for example, if you look at the 195 strike again, there's a 40% chance of this being in the money, but at the same time, there's a 61% chance of this being the put being in the money. So that works out to 101% chance. The market is, so that's not right. But if you look at it this way, the market right now, the market makers are bearish on IBM. So they do not think that IBM will be above 195 within the next, on expiration date 45 days from now, 46 days from now. So that gives you a little indication of what the market is thinking, what the market makers are thinking. Now, normally, puts will have a higher premium, so that kind of makes an effect as well. But just gives you a rough guideline. So now Now let's say we do want to do a credit spread, and like I said in credit spreads, we want to look at the actual short strike. So if we want to sell a credit spread, um, and if our range is, if our trading plan says we want to do it with at least a 90% probability of making money, then the only one we could be doing is probably the 210, because that one is 91% probability of profit. We could also do these others here, but they probably won't give us enough money. So this one right here is the only one that fits into our pop criteria of being 90% or greater. Okay, so that is the delta model. That is how you figure out it very quickly, very easily. It's not exact. It's not an exact science. It's a rule of thumb type thing. If you're doing a trade and you're looking at it and you're saying, okay, I'm looking at this one. Okay, it's lower than a 10 delta. I like it. Boom, I'll do it. Okay, now let's go ahead and do the chart method. So what I want to do is go ahead and pick a spread. Let me move this down a little bit. We'll go ahead and pick the same 210 and we'll compare the two. So sell vertical. So now according to this, what we're doing here, this is the trade that I'm considering. It says sell 10 IBM January 210 calls, buy 10 January 215 calls. So this is a 5-point credit spread. As you see, there's our potential credit. That's what we could be getting. Now let's go ahead and look at a chart and see what probabilities that the chart is telling us. Okay, move it up a little bit more. There you go. Okay, so go ahead and set the slices to the break even. There we go. We have to make sure that our probability date is set on expiration day, which it is January 20. And according to Thinkorswim, the probability of profit for this trade is 86.7%. It's a little bit lower than the 91 that we came up with our delta model because there are other factors included in this calculation. So it's about the same, but it's a little bit, tad bit lower. So if you want to stick to the rules and you want to be exact, then you probably have to use a calculation from the chart, from the software. Otherwise, you might just use the delta to be quick. So now, basically what this chart is saying here is that there is a 86.7% chance that IBM, the stock of IBM, is going to be trading in this range, anywhere above 210.27, because this is our break-even line right here. It's not exactly at 210, it's at 210.27. That's our break-even. So there's an 86.7% chance that IBM will be above this line. It could actually, sorry, it's going to be trading below this line. Because here the prices are going down. So it's going to be anywhere below 210.27. And there is a 13.3% chance that IBM will be trading on expiration day above 210.27 in this range, anywhere above here. So according to our trade, as long as it's in this range, we make money. If it's above this line, we lose money. So we have a 86.7% chance of this particular credit spread making money. Now this is what this is actually telling us. Now, there are different ways to change the parameters of this trade. For example, according to this, IBM has a yield of 1.57, which is dividend. If you increase the dividend, if you change the dividend, the probability profit will change. If you change the volatility, then the probability of profit will also change. So if you can see here, as volatility goes up, your probability of profit is going down. So watch this number as I increase the volatility. See how it's going down as volatility goes up? And then what if we decrease the yield? If we decrease the dividend, then probability of profit also goes down. If you increase the dividend, the probability of profit goes up. So these are two other things that are included, including days to expiration. So if you want to change the date of expiration, let's just make it here January the 2nd. Oh, see, our probability of profit just jumped up to 90%. But that's not our expiration date. So we're looking at 84.99%. Let's go and put these back to where they were. Okay, and that's exactly where we are now, 86.7%. So this is how you calculate probability of profit using the chart. We also looked at the delta model for a quick rule of thumb. And if most of the time this holds out, and it holds out, it's not exactly the most, it's not guaranteed, it's not set in stone, and it works for credit spreads. It gives us a good indication. So if you're looking at different trades and you're saying, you know what, I might do the 200. Okay, well, just looking at the delta here, it's telling us that, if we are looking at a 80% or 90% probability of profit trade, then this is going to be too high. If you're looking at this one, let's say we wanted to do an 75 to 80% probability of trade, then we can go ahead and take a look at this one, do the math, and look at the chart and say, you know what, the chart on this one, let me go ahead and fix it. Okay. All right, so this chart at break even actually gives us an 80.81% probability of profit. So that fits between our rule of 80% or higher. So I like this trade and I get more money for it. I get a 63-cent credit versus the 29-cent credit that we got for the other spread that was 5 points away. So, you can take a look at different trades based on the probability of profit. So that is the POP. That's what it is. That's how we use it and how we calculate it. Alrighty. Thank you. On to the next one.